Hello, everyone. My name is Bridget Ryan. I will be discussing the end of Chapter 11, specifically pages 1122 to 1131. This section in Chapter 11 will discuss liquidating distributions and how that computes gains or losses for a company and shareholders. It will mention several taxes paid under certain circumstances. Lastly, based on the income taxes, there are particular filing requirements on some taxes that will be discussed. I will provide examples, pictures, and forms that can aid in understanding the information a little bit better. For distributions, we're going to be specifically talking only about S corporation liquidation. And as mentioned on the slide, there are particular rules, consequences, gains, or losses. Instead of using partnership tax rules on an S corporation, we'll follow corporate tax rules. The gain or loss for the consequences under 331 and 336 shall be recognized to a liquidating corporation on the distribution of property in complete liquidation, as if such property were sold to the distributee as its fair market value. This rule governs the tax consequences. It doesn't mention it in my specific section of the chapter. However, these consequences are mentioned in a C corporation liquidation a little bit before the section I'm covering. So if it's hard to understand these consequences, I would research them a little bit more in the book and in separate areas such as Google and other great platforms for research. However, as an S corporation recognize gain, but they do not recognize losses on operating distributions of non-cash property. Gains and losses allocated to shareholders to either increase or decrease their stock basis. Stockholders recognize gain if value of property exceeds their stock basis. Likewise, if it does not exceed it, it becomes a loss. Therefore, I have an example here from the book that I think does a really great job of understanding how both the corporation and shareholder get their distribution gain or loss. As you see in the example, the company's gain or loss comes from taking the aggregate property distribution, so $60,000, as you see right here, it mentions it in the summary above, less the aggregate basis. So if 36,000, for example, was actually 65,000, you would not have a positive value. Therefore, it would be a loss. The example shows the solution on how each number for Nicole is calculated. So Nicole is a shareholder, and I think this does a great job giving you values that have numbers in the summary above that give you a good understanding for future problems. So if you ever have trouble, I would follow these exact steps because all the information is given in the summary. So there's three different taxes most commonly made by S corporations. The built-in tax is going to be what is used most. However, there are two others. It's going to be the excess net passive income tax and LIFO recapture tax. For the built-in gains, it was enacted by Congress to ensure C corporations do not avoid corporate taxes on sales of appreciated property by electing into an S corporation status. Any S corporation that converted to a C corporation with a net unrealized gain at the time is subject to this particular tax, and has to be within the built-in gains tax recognition period. There are particular years that this recognition period is, so if that is the case for the company when converting, that's how they will be recognized as this tax. This represents the net gain that the corporation would recognize if it sold each asset at its fair market value. This is measured on the first day of the corporation's first year as an S corporation. Now, if there is a loss, there will not be any tax paid. So as you see in the example, this does a great job laying out the fair market value, the adjusted basis, and what the built-in gain or loss would be. Now, as mentioned here, you see that to calculate it under the accrual method, this is how they have it set up. However, under cash method, receivables would be gains and payables would be loss items. So in here, they have a $20,000 gain between the inventory FIFO method, and they have a loss of $25,000, even though the adjusted basis is higher in this one. So since it became a loss at the end of the calculation, since the $25,000 did not exceed the $20,000 positive income, it's $0 that they would have as unrealized built-in gain. They would not be subjected to this tax. I'm going to give you an example of how it would be different if the numbers were calculated differently. Now, limited to the lowest of 3 different categories is also how the tax is calculated. So the first one is the net recognized built-in gain less any net operating loss and capital loss carryovers multiplied by 21%. Look at example 1124 for more details. So in the book, you could see example 1124 for it. 2, net unrealized built-in gain not yet recognized. And 3, Corp's table income for the year using the C Corp tax rules exclusive to dividends received. Those are going to be different ways you could calculate if a company is supposed to use a built-in gains tax. The second tax is going to be excess net passive income tax. To calculate, you would use your net passive investment income times passive investment income minus 25% of gross receipts divided by passive investment income. So, therefore, if there is excess net passive income, there is a tax on the amounts. The tax on the amount would be 21% of that excess net passive income. In order to find how much the tax is calculated, you would use this equation right here. The tax is levied on a S corporation that has accumulated earnings and profits from years in which it operated as a C Corp if the corporation reports any excess net passive income. This tax was created to encourage S Corps to distribute their accumulated earnings and profits. There's only excess net income if it has net passive investment income, and that passive investment income exceeds 25% of gross receipts. There are different things that go into what the gross receipts are. For example, the total amount of revenues, including the passive investment income received or accrued under the corporation's accounting method and not reduced by returns, allowances, cost of goods sold, or deductions. So for this tax, these 2 equations right here are going to be what's best to follow when trying to compute it. For the LIFO recapture tax, it's going to be a little bit more simple. The purpose of this tax is to prevent former C corporations from avoiding built-in gains tax by using the LIFO method of accounting for their inventories. Therefore, it would not recognize built-in gains unless the corporation invaded its LIFO layers during the built-in gains tax recognition period. LIFO recapture amount is the excess of a C corporation's inventory basis under FIFO method in excess of the inventory basis under the LIFO method in its final tax year as a C corporation before it becomes a S corporation. Recaptured amount included in gross income in the last year of operation and taxed at a C corporation's marginal tax rate. Also, if it will increase the corporation's adjusted basis in its inventory at the time it converts. This increased basis will lower the amount of net unrealized gains subjected to the built-in tax because previously mentioned in slides, adjusted property distribution less the adjusted basis is how we obtain the gain or loss for the built-in tax. So this is just an overview slide of the estimated taxes. This is just general rules followed for certain conditions. However, it is not required to make estimated tax payments for LIFO recapture tax. It's only going to be for built-in gain taxes and excess net passive income tax. So certain S corporation filing requirements are going to be certain forms, as in the 1120S and Form 7004 if requesting a filing extension. It's going to be due the 15th of the third month after the S corporation's year end. The extension is automatic 6 months if it's turned in before the original due date of the return. Also, the K1 form for an 1120S is different than the one on the 1065. It does not report self-employment income. It does not allocate entity level debt to shareholders and does not allow for shareholders to have profit and loss sharing ratios that are different from shareholder percentage of stock ownership. So these are just some examples of the forms here. I broke it up so you could see it better. It's just a continued part of the 1120S form. They have to include the corporation Schedule K, and this will be the Schedule K1 for the actual shareholder and what they would put in there. This is just the first couple of differences from a larger table on the second to last page of the chapter. This is great for understanding how each tax characteristic affects a certain business entity. This is going to be Exhibit 11.4. Overall, this section of the chapter included how liquidating distributions governs the tax consequences from gains or losses made from adjusted amounts. This amount plays a critical role in built-in gains taxes as well. This section included 3 taxes a S corporation that was previously a C corporation is subjected to under particular circumstances. The filing requirements on income taxes made from built-in gains and excess net passive income tax. Also, several slides shows pictures that capture important documents or examples that can help and aid in understanding that information. So I hope you enjoyed this presentation. Thanks so much for watching, and I hope this gives a better understanding to the chapter.